Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of sensitivity analysis: what it is, why it matters, and how to use it effectively. How do small changes in a variable affect the outcome of a decision or model? That's the question sensitivity analysis answers. It helps identify which inputs matter most, so you can make smarter decisions. From predicting financial risks to designing safer systems, this tool is used widely across industries. Whether you're managing investments or solving environmental challenges, understanding sensitivity can give you a clearer path forward. What is sensitivity analysis? Sensitivity analysis is a way to test how changes in one factor can impact the result of a model or decision. Think of it as tweaking the dials on a machine to see what happens. By doing this, you can figure out which inputs are driving the outcomes and which ones don't matter as much. It's a tool to reduce uncertainty and focus on what truly affects your results. Definition and purpose. Sensitivity analysis is a technique used to understand the relationship between inputs and outcomes in a model or system. It helps answer questions like, what happens if this number goes up or down? Or, which variable has the biggest influence on the result? The main purpose is to identify critical inputs and assess their effects. Whether you're forecasting financial performance, assessing risks, or optimizing a process, sensitivity analysis ensures you're not flying blind when making decisions. It shows you where to focus your efforts and helps protect against unexpected surprises. In short, it turns uncertainty into clarity. Key components. A successful sensitivity analysis depends on understanding a few core pieces. These include variables, parameters, and the models themselves. Let's break them down. Variables. These are the factors you're testing. They could be costs, interest rates, or even weather patterns. Think of them as the pieces of the puzzle you want to adjust to see the ripple effects. Parameters. These are the fixed values or assumptions within the model. While variables change, parameters stay constant. Together, they create the framework for your analysis. Models. The model is the system or formula linking your variables and parameters. It could be anything from a simple spreadsheet formula to a complex simulation. This is where everything comes together to test different scenarios. By adjusting variables and observing the results in your model, you can pinpoint what matters most. For example, if a small tweak in one input creates a big change in results, that variable deserves closer attention. At the same time, components with little to no impact can often be deprioritized. Types of sensitivity analysis. There's no one-size-fits-all approach to sensitivity analysis. Depending on your goals, you may need to zoom in on fine details or take a step back to see the bigger picture. Below, we'll break down the 3 main types of sensitivity analysis and when to use each. Local sensitivity analysis. Local sensitivity analysis focuses on small, incremental changes in a single parameter while keeping everything else constant. It's like turning one knob at a time and watching how the output shifts. This approach helps identify which variables are most sensitive to slight adjustments and how they influence the results. For example, if you're tweaking interest rates in a financial model, local analysis can reveal whether a 0.5% change significantly alters your profit projections. It's best suited for systems where the relationships between inputs and outputs are linear or relatively simple. The downside? It doesn't account for interactions between different variables. This method is ideal when you're testing specific assumptions or validating key inputs in controlled conditions. However, if your model has nonlinear relationships or complex dependencies, local analysis might not capture the whole story. Global sensitivity analysis. While local sensitivity analysis fine-tunes individual variables, global sensitivity analysis takes a more comprehensive approach. It evaluates the impact of varying all parameters across their entire range, often simultaneously. Imagine adjusting multiple dials all at once to see how the whole system reacts. This method is particularly useful for complex models with unpredictable behaviors. For instance, in climate modeling, examining how temperature, precipitation, and carbon emissions interact can provide more accurate risk assessments. Global analysis offers deeper insights into variable relationships and their combined effects. It helps answer questions like, which factors dominate the outcome, or how do variables behave when combined? While it requires more computational power and detailed data, the results can lead to better informed decisions, especially for large-scale projects. Comparative sensitivity analysis. Comparative sensitivity analysis goes one step further by looking at differences across multiple models or scenarios. Instead of focusing on the response of one system, it compares how varying inputs affect several systems side by side. Think of this method as testing different strategies. For example, let's say you're comparing two investment portfolios under the same economic conditions. Comparative analysis can highlight which portfolio is more robust or vulnerable to changing factors. This technique is great for making decisions where trade-offs are involved. Should you go with the model that minimizes risk or the one that offers higher potential rewards? Comparative analysis can help you evaluate those choices and decide what aligns best with your goals. When applied effectively, it provides a clearer understanding of which model performs better under various conditions, helping mitigate risks and enhancing decision-making. Applications of sensitivity analysis. Sensitivity analysis has a wide range of applications across various fields, each benefiting from its ability to identify critical factors and predict outcomes. Below, we explore how different industries use this powerful tool to improve decision-making and optimize results. Finance and investment. In finance, sensitivity analysis plays a key role in evaluating risks and guiding investment strategies. It shows how changes in specific variables, like interest rates or market conditions, can influence profitability. Imagine you're assessing a stock portfolio. By tweaking variables like inflation rates or earnings growth, sensitivity analysis can highlight how stable your investments would be under different scenarios. This helps investors identify weak spots and plan for potential downturns. It's also commonly used in loan assessments, capital budgeting, and valuation models. For instance, in discounted cash flow (DCF) analysis, it can reveal how sensitive a project's value is to assumptions about growth rates or discounting factors. This ensures decision-makers focus on the most impactful variables and reduce financial uncertainty. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.